We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Rebecca Chung-Wilkins with David Ingles.
Let's get to your top stories today. The Biden administration is said to plan further limits on AI chip exports from the likes of NVIDIA in a final salvo against China's tech ambitions.
And Asian stocks dip while bonds are under pressure as traders look ahead to Friday's U.S. jobs report.
MSCI China benchmark index, of course, meanwhile, is close to bear market territory and mounting economic headwinds. You have consumer and producer price figures due this hour set to show deflationary pressures persisting.
And to that end, China is also pledging to deepen its anti-corruption drive across various industries, including finance and energy.
Good morning from Hong Kong. Welcome to the show. Equity markets, as you can see here to my right, are under pressure right now. 0.3% is the pullback, broadly speaking, across the benchmark. We're pulling back about 0.25% S&P futures. Of course, keep in mind, the closer we get to sort of the jobs report, the more conversations we'll have on really, do yields need to be this high? That's another conversation. But of course, just keep in mind, the melt up in yields has really been, at least the last 48 hours, has been really a headwind for equity markets. We are seeing that in the Asia Pacific. Aussie and Japanese 10-year yield. One market that is coming online right now to pay attention to right now is Singapore, pulling back 0.5%, really on the back of, well, the index closed at an all-time high yesterday. Of course, we're watching all things in the UK, of course, following that massive melt-up in UK gilt yields yesterday. At these levels on cable, we're actually extremely close to taking out the low, the trough, back in 2024, that then takes us back to somewhere around the mid-2023 levels, and that, again, a stronger dollar story. Flip the boards, have a look at the setup as we go into the Chinese market and the open there. And, of course, you just saw the headline coming through out of the PBOC. Might have to do, of course, with the currency and where it is right now, 735.42. Golden Dragon Index overnight, 0.7%. So just two figures to tell you about 20%. We're nearing the 20% threshold, which would put us in a bear market on MSCI China. That's figure number one. Figure number two is 0%. You have a lot of economists coming out, looking at this inflation print that's coming out bottom of the hour, have that forecast for inflation for December. One of those economists, in fact, is joining us at the bottom of the hour. Out of credit, Agricole. Okay, very quickly, as you look at that bear market, how far are we? We have a chart that sort of shows you that. And interesting enough, we are actually approaching several key levels along that level. So on the 200-day moving average, that's actually, so right below that is actually we do enter bear market there, although some of the technicals indicate that you might get some dip buying because it does seem we did fall a little bit too much too quickly. But we'll see. Certainly momentum, Rebecca, is certainly to the downside at this point in time.
Yeah, an enormous amount to track there, David, really across assets for China today. As you mentioned, these key levels that we're looking at for MSCI China, that 61 bear market level, HSI as well, the level on your screen you're looking at there, the bottom end of the range after stimulus. This briefing we had yesterday on the expansion of trade-ins, I don't know how many rice cookers we all need, but, you know, markets weren't really convinced. It didn't really deliver the push that some were hoping for. And then again, December inflation data there, as you point out, zero and potential as the mode for the estimates coming in. And zero is a milestone. If we hit zero, it's going to be the first time since January 2021. Are we going to see deceleration there for fourth straight month? Let's see. Elsewhere, sectors for stocks, chips in focus with this new Biden administration. That's a fantastic Bloomberg scoop we have there on another round of restrictions for chip AI. Hong Kong property also, Citi turning more bearish. We had a note on that earlier today, including sort of trade tensions, issues around home supply. We're also entering the window for credit data. And finally, Tencent buybacks, really underscoring the concern of urgency around the need to sort of offset after Tencent, among other Chinese firms, were added to that Pentagon blacklist. Now, Sticking on geopolitics, we're watching NVIDIA's biggest suppliers this morning following this Bloomberg scoop that the US may restrict further its AI chip exports, along with those from AMD. For more, let's bring in Asia tech reporter Annabelle Jewellers. Annabelle, just break down the latest. What are we seeing? And explain the sort of three-tier system.
Yeah, this is really the heart of it, the three tiers. So we know, of course, that the US has been looking to restrict China's access to cutting-edge technology for several years now, but this is sort of like the last salvo before the US administration changes over, of course, President Trump in office in just a couple of weeks. But what we're hearing from sources, and this is, again, not confirmed just yet, but the Biden administration could be looking at creating a so-called three-tier system. So it's about giving access or controlling the access to compute power across a range of countries. So the first tier, that's the US's allies, essentially, so Japan, Korea, Taiwan here in Asia, Australia, Western Europe, some other places as well. That's the one that gets the unrestricted access. Then you've got tier 3, and you can imagine, of course, that that's the countries where the US already has some sort of arms controls in place. So Russia, China, Iran, they're the ones that really stand out in that category. But the category 2, or tier 2, is where it gets a little bit more nuanced and more complex, because that's essentially rest of world. So you've got, South, Central America, large parts of Africa, India, across Asia as well. These are all countries and companies that are headquartered within them that will now need to go and negotiate with the US government. Of course, if this is put in place, we're hearing the restrictions could be announced by Friday, or the new policies, but they would need to go and prove essentially that they've got a demonstrated track record of engaging with US government officials, that they meet certain human rights standards, other sorts of metrics in order to get greater access to those AI chips that go into AI servers.
Talk to us about reaction.
Yeah, so it's sort of a mix. I mean, you can see here today that the suppliers in Asia aren't really paying too much of attention to this story. I don't want to downplay the story. It is significant, but I think it also speaks to the fact that we don't know how President-elect Trump would handle this either, and whether he would actually continue with this policy if it were announced. So there's a great amount of uncertainty with this. In terms of what we saw on Wall Street, we saw NVIDIA slipping, we saw AMD slipping in after hours, but the companies themselves, of course, they're not very happy about this. And NVIDIA's put out a statement, and they're saying that if you've got this sort of last-minute restriction that you put in place, I mean, have you really thought through the policy? And is it going to really have the intended effect either? Because, of course, the flip side, when you so heavily restrict China's access, it also just reinforces their need to develop their own supply chains and their own sufficiency or self-sufficiency in this area as well. But bipartisan support, that's undoubtedly in place, because members of Congress just last week wrote a letter to Gina Raimondo saying that this is a serious, once-in-a-generation moment to curtail China's advances in this space, and also to private countries and companies from its grasp.
Belle, thank you. Annabelle Jewellers there, our tech reporter. Let's have a look at the market implications of this. Might this actually be the risk that markets need to pay attention to, this Teflon U.S. bull market? Mark Konyn is with us here on set, CIO of the AIA Group. Nice to see you, and good morning and Happy New Year.
Good morning. Happy New Year.
Might this be the risk? Might this be the catalyst that leads to the end of this U.S. bull market? Because nothing so far has.
I don't think so. I think what we're seeing now is the next phase of this bifurcation in terms of the use of technology, and the division lines are being drawn. And, of course, we know what's coming next with the new administration. We don't know the details. We don't know the shape and form and the sequencing, but the direction of travel, I think we know.
Just to pick up on some of those risks for US companies in particular, I mean, the Pentagon blacklist, we've had Tencent added, a couple of other names. The four biggest Chinese companies, the market cap totals $1 trillion US. So it is a significant potential hit. How damaging is this for US companies if we see them discouraged from doing business with firms of this kind of global reach?
I think what it does is creates a level of uncertainty, because it is an open process. You can challenge, and companies have disputed being included on these lists and been successful through that dispute. But it creates another level of uncertainty of how this split between global powers, the geopolitical dimension, is going to play out in a commercial sense. And that's what investors don't like. Unknown outcomes from policy, and that's where investors are going to be cautious.
On the other hand, though, there is the underlying tide here is a U.S. economy that, seems to be on the other side of a credit cycle. Again, it seems to be that we might need to have a conversation around when the next Fed hike is going to be. How strong of an offset is a stronger U.S. economy to all these risks?
So the U.S. economy is going to be growing above trend level for 2025. Not as strong as 24, but still strong. And relative to other major economies, it is significant. It's where the productivity growth is, it's where the innovation is, it's where the growth is, it's where the earnings growth is. You could argue it's also where the high valuations are, but it's where money is going. It's the direction of travel, if you like, for investment dollars, and the US will benefit from that. We sort of see another 10% on the S&P for 2025. So,
wow.
Another positive year, maybe not as positive as the last two, but another positive year. So if you think about in a multi-asset strategy, that domination of US equities, and we can talk about whether or not the market is too concentrated, but that domination is going to be very much the theme, certainly in the first half of 2025.
Let's quickly talk about that concentration. Are you seeing an over-concentration?
You're certainly seeing, from a risk perspective, 75% of the risk on the S&P is coming from the Mag 7, 25% for the other 493 stocks. So, there are consequences of that if the Mag 7 slip up. It's going to have an impact across the whole market, because that's where the risk, the total risk is occurring. But having said that, we are seeing a broadening out in the market, and that is an opportunity to reposition and take advantage of those companies which are now growing reasonably well and are not heavily correlated necessarily with in the same industries.
And to you guys, is that a compelling enough opportunity to broaden out that U.S. equity trade?
Yes. I mean, we've been cautious of being over-concentrated in our equity portfolios, and the fact the market will broaden out. If you think about some of the strategies we're looking at, we're sort of lightening up on some of the chip manufacturers and more into the software companies that are going to benefit from the innovation of AI.
I just want to turn to China here. I mean, last time you were with us, you talked about the big issue being this problem of consumer confidence. What do we need to see to restore that? What do we need to see, or can we do it without this sort of direct-to-consumer element?
So you're not going to get the direct-to-consumer element. We haven't seen it in China. We haven't seen it in this part of the world as we saw in Europe and North America. So that's off the table. We continue to see a lack of confidence amongst consumers. You've got $20 trillion locked up in cash in the banking system. You've had an administration which in 2024 was very focused on making sure that there was sufficient resiliency in the banking system to withstand shocks from the property downturn, and also to shore up the financial situation with local governments. Successful, structural, but didn't feed through to the consumer. Still a lot unknown. Beginning of the year, dearth of data, and we're all waiting for the NPC. So not a lot's going to happen in absence. But what we would want to see is fiscal stimulus. I don't think it's forthcoming.
We're getting a lot of sell-side calls, and certainly the question is timing in the market. It's not so much now if it rallies, but certainly it's sort of more when. HSBC is a good example. They've, again, reiterated and upgraded their call on China overweight. I mean, what's your thought on it? Is it too early to look ahead to, increasing your China exposure?
I think for 25 you're going to see bouts of rallying.
Okay.
But those rallies typically are going to fade because you're not going to see the follow-through. You're not going to see the foreign investors come in, and you're not going to see consumers reallocate that cash. Consumers have done well riding the wave of downward pressure on rates. So the CGB market has been the top-performing bond market globally. We think it's overbought, and we would be lightening up and being on the other side of that trade at this point. But nevertheless, the lack of momentum means that those rallies are going to fade.
Mark, you'll be sticking with us, so we'll have more with Mark Konyn, CIO of AIA Group, later on the show. Now, coming up today on the China Show, Credit Agricole's Xiaojia shares her insights as we break China's December inflation numbers. And we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. This is the China Show.
Right, welcome back. On your screens, you see some strength coming through in the Chinese currency. I would go as far as, and this is my take here, This is probably not the fix, but it was probably the earlier headline 18 minutes back on the PBOC and those bills. But in any case, of course, you put those two things together and you get a move like you're seeing today. Plus, of course, keep in mind the dollar has, of course, been rallying on the way up, and you could make the argument maybe short term it's slightly more overbought on the dollar side of the equation. But again, fundamentals, you have yields on the way up in Treasury, so why not, right? Mark Konyn is still with us, CIO of AIA. You guys must be like a child in a candy factory looking at the Treasury curve.
High yields generally are better for insurance companies, of course. I mean, you've got fixed money liabilities, and if you can earn more on your fixed income portfolio, then you can do more with the rest of the portfolio. We typically don't trade rates. We try and hedge out the volatility from rates because you don't get rewarded for that in the investment markets. But yes, in terms of dollars, definitely higher yields better. We think that's close to the peak, and we would be going long of duration shortly, depending on what happens over the next 2 weeks, 3 weeks, as we start to understand more in US economic policy, financial policy. China's the other end, of course.
Yes.
Overbought, and probably we're the other side of that trade.
Yeah, China's yield discount to the US was at a record yesterday.
Record gap, yeah.
On the China 10-year, for example, you had the likes of Lombard ODA saying we're going to test 1%. Some strategists even saying it might be 0. What's your forecast for how low we go?
So we think we're pretty much about there or thereabouts now. Okay. We think this is largely cyclical, some structural, but we don't buy into the story of the lost decade compared to Japan. We think there's underlying growth in China. I think once we get through this resiliency, if you like, of policy to support the economy as it comes through the effects of the downturn in the housing market, we think the growth will pick up, and therefore we're at the bottom of that cycle.
OK, just on that point, at the bottom of the cycle, what are some of the signs that you are seeing? Are we seeing the sort of concrete effects of stimulus coming through? What are you watching?
Not yet. As I said, last year, 2024, was a year of stability to make sure structurally that the right policies were in place. We're still too supply-focused, supply side in the economy focused, and that's a distortion in terms of allocation of capital. We do need to see consumer confidence come back. We're going to be very much focused on the MPC in March to see what the policy initiatives will be at that point.
You've watched this market for a long time, alongside the evolution of that economic toolkit. And arguably, to the point you just made, do you think the toolkit is still very supply-side heavy? Like, do they have the amount of tools to control?
There is a long way to go, but there is a lot of innovation in the financial system, and we're very much part of that. We have a very large business in China, and we're part of that process of developing the derivatives markets, the financial markets, in order to support the risk transfers that create more of a robust financial system to support economic growth.
Just thinking about the sort of China reinflation story, whether or not we see it, of course, we're waiting for numbers to come through today. What's your forecast for this year? What are you expecting through the first
So a lot of unknowns, Rebecca. You just showed the currency there. If you think about what happened last time, there was the imposition of tariffs. The policy could adjust and allow the RMB to weaken and take some of the heat out of the effect of those tariffs. Where we are trading now, that's not possible. So that will have a negative impact, potentially, on earnings. And that's why we don't see a sustained recovery in equity prices and more sort of short-term rallies and fade.
Back to the CGB question, and I'll put together the reflation story. I think it was sometime last year, I can't remember it was, authorities in China were warning, I think it was the banks, if you're sitting on too much CGBs on your balance sheet, and the market turns, if CGB suddenly sell off, you have a reflation event, then there's a massive risk in some of these banks as well. How do I need to be thinking about the second derivative effects if, in fact, inflation does come back in China?
Well, we've seen significant adjustments globally in bond prices when there are surprises in terms of inflation levels and the impact that has on real rates. I don't think we're going to see it in China because it's not an open capital account, and monetary tools are not as sophisticated. But it's a point well taken, and I think what you're going to see, just as we're starting to think that we want to be the other side of that trade, I think other longer-term investors will take a more moderate view where we'll be over 5-10 years and start to position out.
Mark, thank you for joining us. That's Mark Konyn, CIO of AIA Group there. Plenty more ahead. Stay with us. This is Bloomberg.
Welcome back. You're watching the China show. There we go. A tenth of 1% to the downside. In case you missed it, so perhaps the reason why most of these benchmarks are where they are is you have the heaviest weighted stock in many of these benchmarks actually now has completely reversed all the stimulus gains. We're talking about Tencent here, which, by the way, there's also a buyback story to tell you about there, which we can get to later on. As the stock price has fallen, the buybacks have certainly soared. You can see that really in the volumes and turnover as far as stock goes. So that's story number one. Story number two is inflation. That's coming out in less than 5 minutes from now. Forecast coming up on your screens. The lack of inflation remains, Rebecca, an issue really here. And as you can see, the December data is probably going to remind us of that.
Yeah, absolutely. Watching this very, very closely. I mean, 0%, if we get that 0 for CPI, that is going to be a milestone at that level. First time we get there since Jan 2024. Looking at that very, very closely. That is the mode estimate at the moment, although median at 0.1, just above that. But yeah, will we see a fourth straight month of a deceleration in CPI? It's, we're watching that closely. Elsewhere, though, when we think about chips and stocks that we're watching, chip focus, of course, after this excellent Bloomberg scoop that we had, that the Biden administration basically making this one last push when it comes to trying to curb access to USAI chips. They're introducing this slightly complex three-tier system. Bell was here earlier talking about the sort of second tier. Who are the people who are sort of the in-between? We do have some dealings with the US, but perhaps not kind of long-term, long history of trading. So a little bit of a question mark there. The markets are obviously going to be sort of calibrating what it means for some of those countries. Think about South America, for instance. Anyway, SMIC up just a touch there, pre-market, nearly 1%. It's a busy day for us, David.
And it might get a little bit busier if this index you see on your screens falls a little bit further. 61.05 is the level you're tracking. Bear market on deck, perhaps, possibly. The Open is next. This is Bloomberg.
Welcome back. You're watching the China show. We are counting down to the open of markets here, Dave. Quite a few things in focus, namely the MSCI, the most watched China benchmark. Are we going to get a bear sighting?
We have a bear sighting. Does the bear come up and claw yourself in the face? A little bit more, I think, on the benchmark itself. So I think we're at 61.50, 61, just above that level. That takes us technically into a bear market. So that's 20, how quickly things have reversed, 20% down from the peak. And really, a lot of that has to do with the numbers that are coming through in a couple of minutes, right? So we have the stimulus pronouncements. We have yet to see earnings and the economy respond. And the number that's about to come in 5, 4, 3, 2, 1 is going to tell you that inflationary pressures are perhaps still lacking. These are numbers for December, and they should be dropping on our screens anytime. Now, as we wait for that, declines in the opening goings here for both. 0.25% to the downside here, 0.3% on the Shanghai comp. What else are we tracking here? Can we flip the boards, please? Out of the PBOC earlier on, we did have, of course, maybe some mopping up is how that headline was phrased of liquidity. They'll be issuing 60 billion renminbi in bills in Hong Kong. And typically they do that, of course, to then you do have, of course, a picking up in some things like HIBOR. Okay, here we go. Rebecca, what do you take?
Numbers coming in. So CPI rising 0.1%. That was the median estimate, just a touch over the most common estimate, the 0%, which would have been a milestone. So perhaps a little bit on the positive side. But of course, we still have this whole issue of what the reinflation story is actually going to look like for 2025, whether or not we are going to see enough coming in, particularly when we think about some of these sort of efforts to spur consumption. Of course, we had that briefing yesterday as well.
Yeah, we did. And we've really yet to see sort of major reflationary points. Although I think to the point Rebecca was just mentioning there as well, we are getting a lot more support in details and an expansion really in the trading program and the sort of the categories that includes. this economy is going to need a lot more help on the demand side of things, right? To really things pick up.
Fortunately, we've got the perfect guest to join us to talk us through all of this. Let's bring in Xiaojia, Chief China Economist at Credit Agricole. Let's start with the numbers there. So you were at a 0% estimate. What do you make of the 0.1% for CPI?
I think for CPI, we have to admit that it has been hovering at a relatively low level for the past few months, despite the step up of policy easing. That really shows that China will have to do a little bit more, perhaps a lot more in 2025 in order to really to drive the reflationary back into the picture. We have, if we look at CPI, 0.1%, this is very low compared to the average of 2% before the pandemic. And also, if we look at the PPI, I think is slightly better in the market expectation, but it's still more than -2%. So I think the deflationary pressure is still there in China. So China will have to do more, and we are definitely going to see a little bit more coming in the coming months as well. So
yeah, just on that point, China needs to do a bit more, quite a bit more, in fact. What is it that you want to see, and what will drive reinflation if we do see it?
So, of course, monetary easing will have to come through. The PBOC and the Politburo has already mentioned they are going to implement this moderately loose monetary policies in 2025. So we are going to still likely to see more of the policy rate cut, triple R cut, as well as, the PBOC has its room to expand its balance sheet in 2025 with this outright reverse repos and also continue the net purchase of CGB issuance in order to provide liquidity and drive credit expansion. But monetary easing policy alone itself cannot really solve the problem, because I think in China, I think everybody would agree that domestic demand is still quite weak. So fiscal policy easing will have to come through when the private sector is now quite reluctant to put down the money on the table to, consume very confidently, to expand their, capex. And so that's why the fiscal policy easing have to come through. And make things a little bit more complex, the mix of the fiscal policy easing is also very important. Whether China will be able to do a little bit more of the demand stimulus, whether it will be sufficient enough to drive this consumption keep coming, while if China is still very much on the supply side and look at the continue to really expand this so-called new productive forces that could add a little bit more pressure on the supply-demand balance, that will be a little bit different and difficult. So I think in 2025, I think it will be a continued, battle for Chinese government to weigh various factors and look at the short-term and long-term, considerations in order to drive their stimulus coming through.
Two-part question. What are you hearing the fiscal deficit, the budget deficit target will be, and what do you think it should be?
I think our focus is that the general fiscal budget deficit will rise to 4% compared to 3%. I think this is very much kind of the consensus now. I think after we have heard the various reports after the Central Economic Work Conference, because China will likely to still set a GDP growth target at around 5% to underpin the market expectations to try to boost the confidence on China will continue to make to prioritize economic development and to counter for a lot of the external challenges. So 4%, I think, is quite a bit of a step up and a very important signal compared to their previous around 3% target. But I think beyond that, we will have to see a little bit more beyond that general fiscal budget coming through. So, for example, special CGB issuances, we think will likely to be to raise to 3 trillion, so that it will be including 2 trillion to support consumption as well as investment, plus 1 trillion to raise the capital for the large state banks. So putting all this together and also, if we consider all those quasi-fiscal measures, we think the augmented fiscal deficit for China will be about 2.8% of GDP plus compared to last year.
So I'm wondering, and they've signaled that the growth target, and obviously that's going to become official in March, will be around the same growth rate as last year. And I wonder, from an economic standpoint, does it make sense to set something higher? Because if you go by last year's number, and clearly they met the target last year based on what we see so far, it wasn't enough, though, to spur inflation. And I'm wondering whether there's a signaling utility to being able to then say, here's a higher growth target. And that's a signaling effort to tell the market and tell the consumers that further support is coming.
I think a very important element to really stabilize growth and drive this recovery that the market has been really longing for is to anchor expectation. I think if they set something lower, people will just lose that anchor and think that the Chinese government would not be 100% very willing to continue to stimulate the economy. So that does not really work in terms of how they really want to revive this confidence. So I think China, even though the policy is in room now compared to previous cycles, it becomes a lot smaller, but they still have room to do it, especially through fiscal and through expanding the central government balance sheet. Yep. If we look at the central government, the debt ratio is still less than 30% of GDP. That is relatively low compared to many other economies. Even though we are very concerned about the debt to GDP ratios for local government and the local affiliated SOEs and etc. But for the central government balance sheet, it definitely has room to expand. And also, if we look at the PBOC's balance sheet, it has the PBOC has the balance sheet in terms of nominal GDP is also quite healthy. So if you look at it, it's about 33% of GDP. So it's in comparison to other major economies and a lot lower than, say, BOJ's balance sheet size. So if you look at the PBOC's holding of CGB is really low. So definitely, even though the PBOC is not ready to really introduce QE at this moment, but they definitely has room to do a little bit more beyond policy rate cut and triple rate cut.
Just to your point earlier on the sort of quite muted demand and sentiment in the private market, and also some of those local government strains that you mentioned, there has been this reluctance in some provinces to use their full quota. When it comes to sort of shifting sentiment to really restore confidence, and particularly I'm thinking about credit here, getting demand for credit back, what is the most critical factor in policy making thinking for, so let's say, the first quarter, the first half of this year?
I think the property market easing is something that we hope that we can see more of the measures coming through. We see a lot of pledges already, and so, for example, asking the local government to really drive the destocking of the local housing inventories. That may not be, the pace may not be matching to the market expectations, and may not matching to the pace that to tell the household that, we are indeed seeing a sustained stabilization of the property market yet. So if in the March National People's Congress, if we are hearing a little bit more that China is willing to use more of the resources from the central government to help the local government to solve this issue, I think that would help to bring some of the confidence coming back for the property market. Of course, we are already seeing some of the marginal improvement in the home market, especially in those major tier cities. But for the lower tier cities, I think the housing inventories and the struggles of the local government to stabilize the market is something that they need to address. Because if you look at the Chinese household, the 60 to 70% of the wealth are stored in property market. If they are not seeing some of the real changes here, it's very difficult for them to really be very confident to consume in a sustained way.
Okay, well, hopefully the next time we talk, things will be better. You're optimistic in 5 seconds or so, right? Yes or no? Optimistic?
I'm constructively, positive that China will continue to drive policy easing coming through.
Very nice. Thank you so much. Nice to see you.
Thank you.
Xiaojia, Chief China Economist at Credit Agricole. One stock we're continuing to track right now, about 12 minutes into the session. We're looking at Tencent. I'm looking across my multiple screens here. I can't see it. There we go. Thank you so much. Finally, some upside here. Biggest buybacks since what? 2006. Consecutive days of massive buying out of the company with the stock price where it is. Charlotte Yang is with us, our Asia Equities reporter, to tell us about the buyback and how much they've actually been buying in the market.
Yeah, so we're seeing that Tencent has been doubling down its share buyback efforts ever since it was added by the Pentagon to the Chinese military company blacklist. So we're seeing that Tencent has bought back, the biggest by share account, which is about like 3.93 million on Tuesday. That's the biggest since 2006, and an even bigger amount, on Wednesday. So I think what this, even though putting this into context, Tencent has really been doing that over the past years of like returning value to shareholders. They've been bought. They had a target of buying more than 100 billion Hong Kong dollars in 2020 last year. But even with that, this amount really shows the urgency of trying to calm some investors' nerves. Even though this blacklisting, it doesn't really have a lot of impact on the business operations. There's also no legal restraint in terms of American funds investing in Tencent, but there is some, unpredictability, I think, investors sees, especially with, what's going to come when Trump comes into office in a few weeks. And even if we look at precedents, when Xiaomi, they were successfully removed from that list, it still took a few months. But I think what Tencent wants to do is to come in and help stabilize the shares a bit. And I think today, it's doing a little bit better now.
Talk to us a little bit about the mood on trading floors after this blacklisting news, because part of it is the ambiguity around precisely what this means, whether you can be removed like Xiaomi, whether it means an escalation. What is the mood on trading floors? And also this whole sort of process of buybacks. We had record buybacks last year. Is it actually an effective tool in combating some of this nervousness?
I think it definitely helps comms. And I mean, it's such a surprise move, when everybody just returned from their holiday and then you see CATL, Tencent, the large cap on onshore in Hong Kong, being added to this list. And I think, and also with Tencent, I think if you're like global portfolio manager and you're going to invest in China, it's like has such strong fundamentals. The company communicates with investors well. So I think this and now, seeing that, they're coming with real money, I think it definitely helps in terms of calming the nerves.
You guys are in bear market watch too, right?
Yes, for MSCI China. Last time it was like less than 1%, I think, of hitting that a bear market territory. Yeah. It's a lot of pressure points, I think, for the broader market. A lot of it comes from external. We're seeing, Biden administration trying to rush out things while they're still here, and then you don't know what Trump is going to do with trade, and also the yuan weakness. So there's a lot of things weighing on market right now, and I think what investors closely watching is we're going to see the national team coming to help stabilize a bit.
That's Bloomberg's Asia Equities reporter, Charlotte Yang. They're all across this story. Now, coming up, why China's biggest effort to lure foreign tourists is falling flat despite a growing number of travelers. We'll have all the details on that next. This is Bloomberg. Welcome back. Now, China has eased visa restrictions for several countries last year, opening its doors to a potential 1.9 billion visitors. Unfortunately, only a fraction of those tourists are actually going. So visitors from the US and most of Western Europe have stayed away amid geopolitical spats. Instead, tourists from nearby Asian countries and less developed markets came calling. Bloomberg's Hua joins us for more. Juan, fantastic story, excellent reporting. Just lay out what we're seeing in terms of the numbers here.
Well, it is really, the size and scope of it is huge, and it's an unprecedented undertaking by China to really open its borders to all these foreign tourists, right? I mean, since 2023, we've seen China enact more than a dozen rounds of visa waivers in which they opened their doors to 1.9 billion tourists. And so, of course, the questions we had was, is it working? Are these tourists coming? And where are they coming from? Of course, this being China, data is not readily available, but our analysis did show that, of course, only a fraction of the hoped-for tourists would come. And, you know, I mean, that strikingly, you know, China offered so many of these visas unilaterally, right? It really wanted people to come. It's an independent opening on many levels. You know, these countries didn't reciprocate. And on top of that, I mean, what we saw, of course, Europeans, that they targeted European countries because of the developed economies, more travel spending, and those Europeans also stayed away. Westerners very much stayed away, and it was really the nearby countries, Asians, you know, from Malaysia, from Thailand, from Vietnam, were the ones who really traveled to China quite a bit last year that we saw. It was 23 million. You know, through September, and that was still about 63% of the level in 2019. So really not the very full rebound and really full-throated rebound that China had wanted to see.
You mentioned some of the neighboring sources of tourists, and I'm wondering, is it a matter of proximity? Like, so we know the what, do we know the why?
Yeah. It is proximity. I mean, it's easier, you know, it makes it more accessible. But I think the biggest reason why people have stayed away really, you know, what we heard over and over again, and really what the data shows is really it's a perception issue, right? I mean, China right now has trade spats with the U.S., with Western countries. It's becoming more aggressive, of course, in the South China Sea. And when we looked at this Pew survey of attitudes, it really, there's a correspondence, you know, where in countries like Germany, like France, like Italy, where people have far less positive views of China, we're seeing that also corresponds to lowered, depressed travel bookings as well. And then, of course, you've got the economy, right? I mean, China's weakened economy, it's not bringing in you know, business deals, it's not bringing in investments. And so because of that, travel bookings, business travel bookings are also half of what they were in 2019. You know, I spoke to one very established travel agent who said, you know, at this point, in pre-COVID, he would book routinely side trips for executives coming to Asia. Afterwards, they'd say, oh, book me a leisure trip. You know, I'll join my family in Beijing or Shanghai. And now they're going instead to Japan. They're going to Bali. They're going to Thailand. They're not going to China. So it is, in many ways, a very firm pivot away from China by global travelers.
For our Bloomberg clients and viewers, you can catch the details and look at the details of that story. Fantastic piece. They're comprehensive, a lot of data, a lot of anecdotes as well there from Juan and the team on the terminal and also on the website. There we go, on your screens. We will leave you as well with some live pictures coming through out of KL, Kuala Lumpur, of course. There we go. The Prime Minister on your screen speaking at the Malaysia Economic Forum. In fact, we will be having more. We'll be having more from that event later on. Our colleague Haslinda Amin is on the ground for us there in KL. Plenty more ahead. This is Bloomberg. Right, welcome back. Just to recap, the December inflation figures out earlier on, right of your screens are the estimates coming in roughly in line there with projections, 0.1%. Slightly more inflation than what some economists had penciled in at 0, but obviously, take a step back, that's really a lack of inflation here, Rebecca.
Yeah, no, I mean, how many microwaves, rice cookers, mobile phones are we going to have to buy to get inflation back up?
Yeah, cars, refrigerators.
What have you? It's going to have to be a really big upgrade.
And on the domestic side, really, of the supply of the economic curve there, I mean, to the point that so far we've been hearing from economists that we've heard a lot, in fact, maybe too much on the supply side. The demand side is perhaps wanting, but that's really where I guess the opportunity is in the case for policymakers. And again, the other question too is, have we just not waited enough for some of these policy pronouncements and measures that have been announced and put in place to really take effect?
Right. It's hard to know. We've been sort of talking about these green shoots or so-called green shoots for the last 6 months or so, but obviously we're not really seeing the full consequence come through of a lot of the stimulus measures, property being a really big one. We sort of had these false spurts in, seeming bottoming out. Do we actually get that bottoming out in the first quarter?
To your point, the data certainly hasn't showed it yet. Anecdotally, to your other point, too, first-tier cities are seeing a little bit of a pickup, too, in activity, although on aggregate, does it move the needle on mindset, which is really the crux of the issue here. Okay, look at markets right now. CSI 300 trading flat there. And, of course, this big trading debut here in the city. Not a bad, good day, first good day at school. Well, whatever it is, if you think about it. You're watching The China Show. Good morning. Welcome back to the show. If you join us for the first hour, we're entering the second hour of the China Show, and a look at the CSI 300 on your screen. So we gapped slightly lower, and I mentioned that gap almost with small caps, really, because as you can see, we're back to zero. The other question as well is, we can talk about the U.S. market in a moment. The chip story around our reporting around President Biden, this last salvo. Post the U.S. market close, we did get a pullback as well for the likes of NVIDIA, which, by the way, has been pulling back recently as well. What does it mean for U.S. equity markets later on today? Inflation also coming through out of China about 30 minutes back, roughly in line with estimates. But I think the big story there is a lack of inflation still in the economy. Let's bring in Annabelle Jewellers, our co-anchor for the rest of this hour.
Well, I think what's interesting there, you just pointed out about the chip curbs that could be announced later this week. So the US looking at trying to further restrict China's access to advanced chip-making technology and AI chips that go into AI servers. But the flip side of that, of course, is when you so heavily restrict China, it also just forces that push toward self-sufficiency and reliancy within its own supply chain. And the market reaction today, yeah, we've got China stocks that are sitting fairly steady right now, but actually the likes of SMIC, for instance, Huawei, these China semi names are moving high. So it just tells you, okay, maybe people are gearing up for even more support from Beijing into these names. Yep. But you mentioned, of course, the China inflation story, and that has been really the big theme, that weakness in the economic readings. And stimulus measures, that just really not seem to play out just yet into the numbers.
No, and I think this time yesterday we somewhat had high expectations around the joint briefing yesterday. We did get some details though. Markets, and I think as markets have been behaving so far in China, that they have been front-running a lot of the speculation and the pronouncements, and then they've been selling off on the news. And again, to the point, there are opportunities, there are trading opportunities. They've so far remained tactical, not so much sort of a structural reallocation back into the Chinese market, which is why I guess when you look at this chart, which takes you all the way back to the start of, well, two things here, right? The start of the policy pivot, we're actually almost back to square one. We're not just there just yet, but we are close to a bear market. That's number one. And the biggest stock, most valuable stock in China, which is Tencent, is a lot less valuable now because of the risks that we've seen play out this week. Yeah, well, being added to a list in the US that essentially a list that the US is deeming that they've got some sort of links to the PLA. Now, it doesn't actually prohibit any sort of trading activity with Tencent, but it certainly does cast a big shadow over the stock. We'll be digging into the details of that more this hour, really what it means for the broader relationship between the US and China. But right now, of course, that big focus on inflation data just dropped in the last 30 minutes or so. Yeah, absolutely. Let's bring in our team, of course, out of Bloomberg Economics to take us through their initial take on that. David Xu is here on set with us for your initial reaction to the numbers.
Well, it's complicated to be honest, because
why?
If you want to seek some positive inference from the data, you can. Because if you look at the month-on-month move of the prices, you can find it didn't decline as the previous month. But if you look at the big picture, the things are still worrying because the PPI has been in the deflation for several months in a row, and the CPI is barely inflation, but we still think that we can not interpret it as a good thing. So overall speaking, I think for myself personally, I think China is already in the inflation, because if you look at the average of the CPI and the PPI, it is negative.
And that doesn't seem like the trend is going to be reversed anytime soon either.
Well, it recalls my memory in early 2000, after the Asia financial crisis. China was in the disinflation situation for several years. Although the numbers can be positive or negative in this month or next month, the things or the disinflation remained almost 3 years. So I think this time for China, it could be hard to reverse the whole thing.
Right, that was our Bloomberg economist there, David Chu. Thanks so much for joining us. Of course, the market reaction, I mean, it's been very telling of the concern that there is, not just in terms of investors that are very bearish on the outlook, but also the expectation that we see further easing. And the CGBs there, for instance, have been the key one to track around that 1.6% level. But we've been saying, some people are saying it could even reach down to 1%. So it's that story of possible Japanification of the economy.
Oh, right on cue. Here we go.
That was right on cue.
The 30-year yield in China slipped below Japan's 30-year last year, and this is one we're watching, of course. We're within 50 basis points on the 10-year itself. And really what I think this tells you from a global asset allocation perspective is why even, I guess to some extent, why even bother looking away from a market and a trade that's worked, which is really a U.S. market that's been it can't stop rallying. U.S. exceptionalism certainly has been the theme so far this year. Does that continue, or has that sort of U.S. exceptionalism conversation run its course? Are there other opportunities right now to at least entertain going into 2025? To help us answer that question, Stephen Wieting, Chief Investment Strategist at Citi Wealth. Stephen, it's nice to see you, and good morning.
Thank you for the invite.
Your thoughts on that? U.S. exceptionalism on one hand, do I even bother looking at the rest of the world?
Well, I would bear in mind, American corporate profits have grown faster than the world, but American share prices have been rewarded even more at a more rapid rate. And it isn't just the 20% outperformance of the last 12 months. It's 15 years of outperformance of U.S. shares. That's the longest stretch in history. So when you can find companies that can execute well in places, it could be India, it could be beaten down markets that are cyclical, that we can find in Latin America, for example. If you take a look at Japan, Korea, if you think about, again, some of these bounce back opportunities, or just the companies that do technology and innovation really well, whether it's in China, whether it's in Europe, these companies are certainly, options to invest in. I mean, you want to think about American companies now, again, the big picture after that 15 years of outperformance, U.S. equities are worth twice as much as all of the rest of the world in terms of traded market cap. So, again, that might be sustainable. We've got a lot going for us. We're not bearish on American earnings, and we're still somewhat overweight U.S. equities after trimming them back. But this is the kind of thing that you might sustain, but would be very difficult to repeat in the next 15 years.
Maybe you don't get to the point of 20% plus returns. I mean, that would be hard, at least historically, to match again. At the same time, it's just that story of such a high degree of uncertainty, not just around Trump's tariffs, what it means for the Fed, what that means for the dollar. And these markets in Asia are particularly impacted by all of those factors. So is it also a case of maybe the better the devil you're a little bit too nervous to also put money into other markets?
Well, that kind of bearishness, again, usually opens the return opportunity. I'll just go back to the first Trump administration. Let's go from 2017 to 2019, before COVID hit. Non-U.S. equities returned 13% per year with the trade wars and with 200 basis points of Fed tightening during that period of time. Now, that didn't match the United States, but now here we are, 40% cheaper compared to when Donald Trump was first elected. So I think that we're in for a volatile ride. We don't think that after a 52% return for 2 years on the S&P 500, by the way, EPS up 10% over that period, right? It came from a depressed 2022. It was a very good time to be overweight large cap U.S., but we just do think that there is a lot of return opportunity, untapped value around many other assets, including some American stocks. Look at the healthcare sector. Look at small and mid-cap profitable companies that have seen their valuation decline for 10 years. So all of this, we've been talking about yields, things that would trouble Asia, but yet yield opportunities are now just so much stronger than they were. The Fed funds rate, the policy rate in the United States, averaged 1.75% for the last 20 years. So just think about what yield can do for a portfolio now. So I don't think it's all about just chasing the last trade.
So simplify it for us. What are your top 1 or 2 recommendations? If it's not simply, I'll just paraphrase it simply. If it's not an S&P 500 ETF,
yes,
what would it be?
Okay, so small and mid-cap U.S. growth companies. Think about software, not just more chips from 2 companies in the world. Think about Asia. Some of the countries that have large export markets that are going to be diversifying sources away for supply chains away from China. Think about some of the real domestic-oriented markets like India or beaten down Brazil that have extremely little trade exposure and yet still have, in the case of Brazil, a crushed currency, crushed valuations, 7% dividend yields, 8 times earnings. So you build a portfolio with these things. You build a portfolio with income. We think, yields on loans, for example, can get us to an 8% return over the coming year. Now, when the S&P is up 25%, you'll say, why would I bother? But what if it isn't up 25%?
All right, a lot to dig into in the next block. So Stephen Wieting is staying with us from Citi Wealth, but still ahead on the China show as well. The Chinese government set to widen its anti-corruption drive across a broad range of industries. That includes finance, that includes energy. We'll have the details ahead. This is Bloomberg. You're watching The China Show, and we're back with Stephen Wieting. He's Chief Investment Strategist at Citi Wealth, and they've got a 2025 outlook cautioning against long-term or investors relying solely on the S&P 500 for returns. That's what I wanted to say. But the point is that you've got 10 opportunistic positions, and there's one that actually stood out to me in particular, and that's the defense contractors. And I'm curious if that's something that you're also looking at in an environment of rising geopolitical tensions.
Well, it seems as if geopolitics is driving business. This is far from the ideal world we wish we could invest in where that wouldn't be a factor. But we believe that defense deterrents are still going to be a strengthening business that ideally, again, can be the way in which we get less actual conflict in the world. Now, but that isn't sort of the basis for the investment. The whole point is that what's happened in Europe, what's happening around the world, broadly speaking, geopolitics is driving a lot of investments. There's cybersecurity investments, again, are very much the same sort of thing. Now, some of this is not really related to state actors or conflict, but all of these things are not ideal things that we invest in, but are important things that are being driven by, in some cases, geopolitics.
Talk to us about one of the other items here, which caught my eye at least, is enablers of cryptocurrency growth.
Well, this is, again, under a basket, a bunch of these things are deregulation beneficiaries. And in this particular case, we went from an environment of great uncertainty about whether the infrastructure to build digital assets and trading, these sorts of things, would occur in the United States, and now a regulatory environment that's going to very much be permissive on this. Now, these digital assets, these companies will be on a wild ride. It's one of the, again, higher risk positions. But broadly speaking, in some cases, away from the crypto itself, you're dealing with companies that provide this infrastructure that are below 2021 levels. And it fits into broader financial deregulation. Now, perhaps it isn't going back and unwinding all sorts of capital rules, these sorts of things. That's not what we're talking about. At the same time that we have new deregulation in the financial system, we have to remember the yield curve was inverted for 28 months. That held bank profitability. Tight spreads, a high cost of funds, M&A activity 40% below 2021 levels. It's not really a surprise to see that banks and derivative plays on that, even, again, alternatives like digital assets are part of this trade of recovery.
What else stands out to you on the list? What's sort of your other priorities?
Well, let's think about some things that are a little bit, lower in risk. Medical equipment and supplies. In general, the healthcare sector is just like technology. It's rising as a share of corporate profits. throughout the world. And yet it trades with a very low confidence level in the future of profits. Information technology trades with great confidence about the future of corporate profits, but healthcare trades cheaply. Medical equipment, supplies, tech, all of that has been in recovery. We think that, like tech in 2022, EPS are recovering now, inflecting more positively. And you can think about that as a defensive growth industry that is relatively depressed.
What about alternatives? How much has that come up?
Well, quite strongly. We've done a lot to try to rationalize and really get to the heart of what returns could be like in private markets.
Right.
And when you think about, even if you have conservative exit rates, for private investments, we still get to a 10-year return outlook of over 12%, 12.5%. So if you think about all asset markets have rallied in the past couple of years, our 10-year return estimates have come down because they're higher in price. That's what happens when things get richer or cheaper. And we think that those assets in private markets, again, lag behind public markets. So in many respects, there's still a strong return opportunity there that stands out compared to S&P 500.
Yeah, I think in case our viewers missed the earlier segment, you were making a very good point about where yields are in a fixed income space. People are sleeping on how that could actually boost your annual returns. And I'm curious, with Treasury yields, say, let's call it 5%.
Yes.
Is that an enabler, or does that discourage people from going into upward parts of the fixed incomes, including private credit, where you get maybe 12 to 15%? In other words, is 5% good enough for most people?
The adjustment process of getting to 5 probably, again, harms all markets. We have to reprice. Every asset affects every other one in the world.
Okay.
And the rise that you have in yields does create some more volatility and concern. But when we think about stronger return opportunities in fixed income, that could be 6 or 7% U.S. dollar returns. It's not just treasuries, right? The whole market for high-quality fixed income is getting this stronger base rate level of U.S. treasuries in it as an entry point for fixed income.
So how do you position, then, for the renewed volatility?
Well, for one of those things, hedging, and hedging is not something you can say, today and look back a month and say, you have to, again, be very active, every single day in this. But, if you looked at that list, one of the things we think is that the VIX will be higher on average this year than last year. Just as a wider range, as a new administration, we know less about it than the last one. A whole possibility for different aspects of policy moving markets around the world. So with a more volatile market, you have to have an asset allocation that you can live with. It might have been fine to pick 3 tech stocks last year and say, I wish that was my whole portfolio. But that's probably not the lowest, the best risk return opportunity, right, that you have going forward for a portfolio.
How do I need to be thinking about currency exposure? To the point that Bell was making on hedging, for example, and one of the things that you mentioned that is part of the list, very few though, is Brazil. So for dollar investors, how do I need to be looking at non-dollar exposure? And for those that their starting point is non-dollar, how do I need to be thinking about that?
You look at the U.S. dollar now at its second highest level in history. We saw when the first Trump administration came in, almost all of the political change was priced in fairly discreetly over the course of 2 months. And, we now have thought that the Federal Reserve would not ease quite as much. The market goes wild in terms of going from pricing in excessive easing to no easing at all or tightening. And the Federal Reserve is on course to deliver most of the currency weakness that we're going to see from the dollar is going to be driven by the Fed, not other central banks. So Japan wants to raise rates very gradually. Well, if the Federal Reserve says that its long-term policy rate is 3, here it is at 4.5, it's going to be the Fed that's going to be taking down, again, the U.S. dollar relative to Japan at some point. Now, again, is it going to be gradual? We're not, again, investing with a whole lot of U.S. currency weakness in mind, but we're thinking that a lot of the hardship, right, the idea that the U.S. will harm the world with the strength of its currency, a lot of that we think is out of the way.
Last question. If someone comes to you and they say, Stephen, I've got $100,000 to invest this year, what would be your recommendation?
Well, it's going to be depending on what their risk tolerance is, on what exactly they're trying to accomplish. And if we're saying that it's a medium risk investor who's investing over the longer term, it's going to be global not just U.S. It's going to be very broad in terms of its exposure to asset markets that lagged behind large cap tech in the last 10 years.
And would the non-global footprint there be less than 50% or above 50%?
Oh, it's less than 50% at this point. This is something that we have to transition to. Right. I think earnings broaden. I think that we can get some of that stronger performance this year after whatever wild ride we get. But this is the kind of thing that we're not taking some sort of wildly strong bet that U.S. exceptionalism is over. It's not like that. But it's certainly priced with great confidence.
There we go. Fantastic to see you, Stephen Wieting there, Chief Investment Strategist at Citi Wealth. Plenty more ahead. This is the China Show. Welcome back. Here are some of the big corporate stories we're tracking at this point. So Bloomberg has learned that Bridgewater's Shanghai-based private fund management arm saw around a 40% growth in assets last year. Its all-weather plus onshore fund return, get this, more than 35% for all of 2024. That's more than 3 times the average return for similar funds. That's based on, of course, data compiled by Shenzhen Pai Wang Investment and Management. Now, Bloomberg reported yesterday, of course, on the story, roughly, that Bridgewater had dismissed 7% of its workforce this week in a bid to maintain flexibility. Now, BlackRock says it's letting go of around 200 employees, around 1% of its staff. Now, the job cuts are part of the company's efforts to realign resources and comes after it committed over $25 billion for acquisitions to expand its reach in private market assets and data. The firm says that recent acquisitions will help them hire around 2,000 people this year. Morgan Stanley has promoted 173 employees to the top rank of managing director. Congratulations. That's 12% more than last year, but lower than each of the 2 years prior. Now, major U.S. banks have been bulking up promotions to top ranks, reflecting strong performance and also brighter business prospects. The largest Wall Street firms in the past year have all outperformed gains for broader stock benchmarks.
The big story today, or one of the big stories we're tracking, is this Biden administration move to possibly further restrict China's access to chips from the likes of Nvidia and AMD. So that has been sort of the major one in the last several hours. That's a Bloomberg scoop. Today we're getting the market reaction, and we did see Nvidia and AMD a little bit weaker in after hours, but here are the Chinese chip makers or chip-linked stocks in the session, and you're seeing these moving higher. I think it's a really interesting sort of second-order reaction, and probably one that the US doesn't intend. They of course want to restrain China's advancements in this area, but the flip side, of course, is when you restrain, you only end up getting more investment from Beijing into the sector to increase its reliancy or self-sufficiency. And so, again, you're seeing these stocks rising off the back. These are the names in China. We've sort of seen a mixed reaction for other chip makers in Asia that have more of a supply relationship with Nvidia, for instance. The other big story we're tracking, or adjacent to that, but is NetEase in the session today. This has been an interesting one to watch because we've been really tracking that gaming renaissance of sorts in China. Last year we had Black Myth Wukong coming out. That was the first AAA game that we had ever seen from China. And it is sort of a pickup in gaming demand that we're seeing. And these are companies that as well have exposure not just in mainland China but also outside. But essentially Morgan Stanley has upgraded the ADRs on the PC games outlook. And again, you're seeing that market reaction here today.
Okay, there's another stock. We'll tell you about it on the other side of this break, but here it is on your screens. If you're wondering why, stay tuned for that.
It's 11:29 a.m. in Tokyo. Japanese markets just about to go into their lunch break, and hasn't been the best session really for Japanese equities so far. So they're dropping, as you can see here, quite clearly, but the led by tech firms, also car makers. So there's this continuing concern around the outlook for Fed rate cuts and the impacts of that generally in terms of the outlook for growth as well. And then also you've got this tariff risk, and there are names, of course, that are very heavily exposed to that in Japan as well.
Yeah. How long is the BOJ from today? 15 days? I think the market's sleeping on that risk, that they might do something. Although it might be part, and this is purely speculation on my end, it might be part of the strategy not to give markets too much away to markets right now, if indeed a hike is coming. But it's certainly something that a lot of people have brought up here on shows, that, right? So, because they didn't do anything in December, it might be something that's actually on deck over in Japan. We can talk about it later, but as you can see on your screen, it certainly is still a strong dollar story with a 158 handle here on dollar yen. Go ahead.
The 24th of January, that's the rate decision from Japan.
Okay, there we go. So 15 days. There we go. What else are we doing here? X step. Oh, yes. I'm sorry. I forgot about it. We teased it, but here we are today.
Big reveal, Dave.
This is a big reveal. 2.5% to the upside. This is a company, of course, that's listed here in Hong Kong. It's a Chinese company. Out with some guidance. And, yeah, there we go. And the markets are really running with this. 2.4% to the upside here. Fourth quarter operating brand retail sector through to the single high-digit growth. Takes us into the dashboard today, so a couple of markets to tell you about as you look at markets today. So yesterday, Singapore hit an all-time high. We are seeing a pullback, roughly speaking, across most sectors, most benchmarks, and certainly we're looking at the Chinese market specifically because we're extremely close to entering a bear market on MSCI China and Hang Seng China Index. A lot of that has to do with the recent down leg in Tencent pulling the benchmarks down. Interestingly enough, you have two almost opposing views here. HSBC coming out and say they've upgraded Hong Kong stocks. They have been overweight on China. We put that question, in fact, what the sell side is doing, what the buy side is doing with all these sell side calls on China. And we asked Mark Konyn how he would actually be trading the Chinese markets this year. And this is what he had to respond. This was his response to the HSBC call.
You're going to see bouts of rallying.
Okay.
But those rallies typically are going to fade because you're not going to see the follow-through. You're not going to see the foreign investors come in,
right,
and you're not going to see consumers reallocate that cash. You know, consumers have done well riding the wave of downward pressure on rates. So the CGB market has been the top-performing bond market globally. We think it's overbought, and we would be lightening up and being on the other side of that trade at this point. But nevertheless, the lack of momentum means that those rallies are going to fade.
Yeah, so not really that optimistic, it seems, and not someone who's looking to put too much money to work in China either. I think geopolitics sort of hangs over all of this because I was just thinking about it earlier this morning. The calls that we're getting now, do we need to have direct stimulus, for instance, in China? Do people need to be given cash? Is that going to be enough, or would that be enough to try and spur some sort of consumer rebound? And I think what makes people so cautious to get out, and I do think that geopolitics really plays into this because there's just such a high level of uncertainty between the US and China, the two most powerful economies in the world. But today that's really playing out in terms of the Biden administration.
Yeah.
Last couple of days before they get out the door, and they're still trying to further restrict China's access to advanced technology, possibly extending the curbs, but not too much of a reaction to that Bloomberg scoop so far in the session. But
I'm glad you brought it up. In fact, we'll talk more about this in a moment. But so we've been talking about geopolitics, what it means for market as a risk, what it means for potential earnings impact, and so far most of the focus has been on Chinese companies. If you think about it, the exposure of Chinese companies to the U.S. market is a lot less than the opposite. The exposure of U.S. firms, particularly large cap U.S. companies, to the Chinese market from a regulatory risk perspective, and not a Chinese regulatory risk, I'm talking about U.S. policy risk restricting many of these U.S. large caps from doing business in China. And is that a risk that markets are sleeping on, particularly if you're sitting, again, on an S&P 500 ETF? We put that question yesterday to Helen Zhu, and here's how she phrased the answer.
CATL, for example, was also put on the same list as Tencent. And obviously right now, the U.S. government isn't procuring from them. But what if in the future Tesla's not allowed to procure from them? Then what happens to Tesla? What happens to the global supply chain? And there's not a lot of substitutes for CATL, and the Korean and Japanese alternatives can't come up with the supply in time to meet all of their needs. So if that's the case, it would definitely be negative for companies like Tesla, like Apple, like many of the other major names in the U.S. indices that have performed spectacularly well and have been holding up the indices. So that's something that I think that the new incoming administration has to take into consideration as well.
Yeah, take into consideration, this sort of high fence, small yard. What is that fence specifically? Catherine Thorbeck, our Bloomberg Opinion columnist, thinks that the U.S. does need to clarify the link between consumer tech and national security. She joins us now. Catherine, why do you think that is? Why do you think so?
Good morning. So yeah, I do think that the U.S. needs to be a lot more clear and strategic about when it throws around national security. With Tencent, this big gaming company, when they added it to this blacklist for alleged Chinese military ties, they didn't exactly say what the link was. And we've seen with Xiaomi back in 2021, when they sued to get off the same blacklist, that the link that the U.S. government had between Xiaomi and the Chinese military back then was that they were investing in AI and 5G, which could have military applications, but is also what, everybody was doing at the time. And also that its founder had won an award, which so many other Chinese entrepreneurs had won, including the makers of a chili sauce brand. So I think it's, when we throw around national security so much without sort of a clear explanation of what that means, I think it risks sort of becoming hollow and just kind of provoking Beijing to retaliate.
So there's sort of a precedent there of how other companies have managed this in the past, this designation. Tencent, do you think that they're going to be able to get themselves off this blacklist then?
I do think Tencent will be able to get themselves off this blacklist, but I do think the reputational hit is there. And at the same time, like I said, it's also sort of provoking Beijing and spurring this sort of tit for tat. But like I said, Xiaomi was able to get itself off of this blacklist. And I think with Tencent, we'll either, see what the alleged ties to the Chinese military actually are, which, a lot of consumers and companies are curious, if that actually exists. And if not, it'll just sort of, like I said, escalate this kind of tit for tat and sort of drag more companies into the mix.
So, Catherine, how do we avoid finding ourselves in a lose-lose situation? How do you think the incoming White House and that team should be looking to avoid that outcome?
So I think now is really the time for the incoming administration to sort of take stock of what's been done so far and how this tit for tat has played out so far and what their actual goals are, what they're hoping to achieve, and how they can best sort of not position U.S. tech companies from getting caught in the middle of this whole thing and blocking Beijing from retaliating. So I think now's the time not to sort of run ahead with tariffs and run ahead with further measures, but really to sort of assess what we've accomplished so far and what their actual goals are here.
That was our Bloomberg Opinion columnist, Catherine Thorbeck, there in Tokyo. Now to some of the other geopolitical stories that we're tracking this morning. And advisors to President-elect Donald Trump are said to be considering Michelle Bowman as the Fed's next vice chair for supervision. Michael Barr has said he will step down from the vice chair role while retaining his seat on the Fed's Board of Governors. Trump advisors have also begun drawing up a short list of potential replacements for Chair Jay Powell, whose term ends in May 2026. Malaysian Prime Minister Anwar Ibrahim says he remains optimistic about the incoming Trump administration and its policies and hopes for the best. He spoke exclusively to Bloomberg's Haslinder Amin as his government hosts a major economic forum in Kuala Lumpur.
We were able to sustain for some years now, now the second year. We hope for the best, but the geopolitical situation must be considered, all right?
And what do you think the Trump policies, you talk about geopolitical considerations, how do you think Trump policies will impact?
We hope for the best. We hope for the best because after all, he's very pro-business. So let's be more optimistic and deal with it.
Staying with Malaysia, its second finance minister says growth is set to exceed our top 5% this year thanks to strong FDI and also strong supports from state funds. Now, speaking exclusively to us, Amir Hamza Azizan says that this new special economic zone with Singapore will benefit both countries. Have a look.
It's important to recognize this was not an overnight thing, right? It's been something that both countries have been focused about building alignment, because the most important is to align, to agree that this is possible, and therefore understanding what are the complexities of making it work and what facilitation we can do. And the facilitation could be things in terms of agreeing priority investments that need to be done, facilitation in terms of easing the movement of goods that cross the borders, facilitation in terms of easing the movement of people across borders. And I think that investment that we all did in trying to get that alignment done eases the next stage. Yeah, but if not, it's an idea, then you suddenly run into bureaucratic blockages along the way. The second thing then is actually making sure that incentives which are given, they actually focus about the right things that we want to do. And we saw with the rollout of the GSEZ that tailor-made incentives are matching the desired growth areas in that segment. So in the GSEZ, they've broken down different zones that are prioritizing things such as logistics, manufacturing, digital, leisure and tourism, and all these things. So when incentives are given, they're not given blanket. They're given targeted in order to push that, because then you kind of coalesce the ecosystem in the right form along the way. So I think we've now put ingredients that will facilitate the quick realization of things along the way. And prior years of investments have also come to play, right? Malaysia's infrastructure, whether you talk about roads or rails, are getting better. The connectivity in terms of RTS is growing along the way. And it's building the ease of motion along the way. So again, what's happened is that it's moved from paper ideas to fundamental infrastructure things that are really going to make things activated. So I'm confident that as this thing goes out and announcements are done, discussions are on the ground now to actually realize the first round investments coming.
But Minister, it is about return on investment. How soon do you think you'll see that return?
Well, I think if you ask people, how did Malaysia look at the data centers, for example, right? 5 years ago, it's very scarce and thin. But today, Malaysia is enjoying the capacity, actually realizing the growth in the data centers, because we have the availability of power, water, labor, space, and so on. So I think that conditions actually is being built up. And when we talk about the GSZ, again, move away from what we put on paper, but understand is the infrastructure, the zoning, the things are putting, facilitating that. And I think that base condition is the big change for Malaysia. And I think from a Singapore point of view, I think there are tremendous benefits whereby both parties can gain in terms of pushing segments of businesses in the right zone and helping complement each other to position both countries better.
And of course, jobs is a focus. 100,000 jobs, highly skilled jobs. How do you think those jobs can be filled? Is Malaysia prepared to fill those jobs?
I think Malaysia is learning along the way in terms of how to accelerate the building good talent along the way. The E&E sector has proven that we can do it. And so when we started in the 1970s, it was a new skill set, right? But over the years, we've added in TVET trainings, we've added in tertiary training and so on. We created pipelines of people that can serve the industry. Now we're trying to migrate that in terms of the same methodology into a JICZ sort of methodology, and we're putting incentives to allow facilitation. So if you see our knowledge worker incentive that we put in, a lower tax rate in order to attract knowledge workers to come to Malaysia in order to facilitate accelerated growth along the way. At the same time, commitment put in order to train locals to be able to support the businesses that are coming up.
That was Malaysia's second Finance Minister, Amir Hamzah Azizan, speaking with Bloomberg's Haslinda Amin, and you can catch the full interview at 11 a.m. Hong Kong time on Insight with Haslinda Amin. And we're going to have more, of course, from the Economic Forum in Kuala Lumpur ahead. Deborah Elms from the Heinrich Foundation joins Haslinda later, and also our exclusive with the Malaysian Economy Minister, Rafizi Ramli. Well, coming up on the China Show, we've got Beijing taking aim at sectors including finance, energy, sports as it widens its anti-corruption fight. We'll have the details ahead. This is Bloomberg. We've got an update on the deadly Los Angeles fires. This is being called the worst natural disaster in Los Angeles since the 1994 Northbridge earthquake. Right now, we're hearing that parts of Hollywood have been evacuated as the new bushfire erupts. We have also been talking about Palisades as well, and houses and homes being burned to the ground. So this is a developing situation, but that is the latest there, that parts of Hollywood have been evacuated as the new bushfire erupts. And as we said, the worst natural disaster that we've seen in Los Angeles going back to 1994.
Yeah, there we go. We'll keep you on top of the story. Live pictures on your screens of Pasadena. There we go, which is somewhat in the general area. More on that a bit later on. In the meantime, though, let's have a look at what is trending, and back to this part of the world, trending in China, and a key topic of focus for Chinese media is this anti-graft watchdogs meeting that's wrapped up in Beijing on Wednesday. Now, the regulator singling out areas such as finance and also energy as sectors of focus. Let's bring in Rebecca, who's here with us, of course, on set to talk us through it, to break down for us really what's being said and, where we are in this general story here.
Yeah, a lot of focus on this anti-corruption watchdog, the CCDI, this week. They had their annual plenum. It's basically been running through this week, and Xi Jinping made these opening remarks, essentially doubling down on this anti-corruption campaign that was across Chinese state media front pages. We're now closing out the plenum, officials reiterating essentially this emphasis, particularly highlighting some sectors, not particularly new here, but again, this sort of renewed and continued emphasis. Energy, for example, is included, finance is included. And accompanying all of this, we also had this new documentary that was put out sort of in collaboration with the anti-corruption watchdog and Chinese state media. And this documentary essentially featured 12 cases across 4 different episodes. If you're looking for something to watch tonight, guys. And essentially all these officials sort of confessing precisely what it is that they did wrong. They go into some details. They sort of euphemistically, one talks about how small things can quickly become big issues. Another one saying that, he sort of dramatically pumped up the GDP number because he was looking for political sort of advancement and ambition. And interesting here that, this is sort of part of the conflict here that actually China faces more broadly, that on the one hand, they are trying to crack down on this kind of corruption. They do not want these sort of inflated GDP numbers, for example. But on the other hand, to what extent does this then lead to officials lying flat? We've talked a lot about this low morale in the civil service in China. Of course, we had that, nice scoop about the pay bump slightly coming through for civil servants. But there is this sort of real risk-off feeling among the government and local officials that it's not the time that they want to sort of take part in risks. And, of course, that's having ripple-through effects in the economy. So really interesting sort of mixture of different themes coming through.
Yeah, the anti-corruption drive certainly sent a chill through private and public sectors, but it still seems like it's not enough to deter Xi from the overall goal.
Yeah, it's really interesting. I mean, this has been a part of sort of characteristic part of his campaign from the very beginning back in 2012. But what we have seen over the last couple of years is it really ramp up. So 2023, 24, we saw record number of Chinese officials being probed. I think Xinhua said the number was more than 50 last year. So there has been this acceleration. And interestingly, we also had a little bit of a shift in tone. We had these very rare comments from Xi Jinping, President Xi, coming out late last year, saying that actually this is a feature and not a bug of the system, that these kinds of disruptions and anti-corruption probes are, quote-unquote, inevitable in order to keep people on their toes, which is a kind of interesting reframing of how he is thinking of anti-corruption. But as you say, it has had this ripple-through effect, particularly when you think about the private sector. We had those very, very prominent detentions in the finance sector last year. That's coming against this warning from the CCDI, also the CCDI earlier, about, hedonistic bankers, warning them not to adopt the sort of Western approach. And essentially this idea of belt tightening across all sectors, the private and public, just at a moment when they are really actually trying to get people spending more.
All right, that was our Bloomberg Asia government and politics correspondent Rebecca Chung-Wilkins. Then we'll have plenty more ahead, leaving you with a look of how Asian equities are faring. And we're actually seeing the Hang Seng turning positive here today, led by tech. More ahead. This is Bloomberg.
Right, welcome back. Just very quickly going through some of the big market moves across your screens. We have LG Energy there. That's an loss story to be more precise here. We were looking for a 16 billion won profit. What we got was not just the opposite, but as you can see, multiples more than what was expected. 5% to the downside. The other one is S-Oil, of course, within the same space there, but this is more guidance along the earnings theme. Brokerage Hana Securities expects robust fourth quarter earnings there out of S Oil. Staying on the energy theme, on the broker theme too, I think we're looking at Shenhua Energy getting a downgrade. We're down about 1%, and the down is coming out of Goldman cutting the stock to sell on its outlook on the coal market. So that's the story there. And just very quickly, we're looking at Hyundai Group. This spending report of quite a massive amount here, 24 trillion. This is one. Yeah, there we go. I was going to say dollars, but like, what are they doing?
That might be underwhelming, I guess. No, overwhelming. Anyway, point is that it's $17 billion US. That's the conversion there. So that plan actually represents a more than 19% increase versus last year's domestic investment. This is the reporting that we're getting from Yonhap, but we have seen shares really reacting positively to this. And in terms of the broader markets, so we're also tracking what's happening in the Hang Seng today and Chinese equities. I mean, there's a couple of different themes that we're really noting here. Firstly, you've had the inflation figures that came out. Yeah. And in line, basically, with estimates, you'd say, at least for the CPI, but it was still barely in inflation territory. And actually, we were just speaking with David Chu before from Bloomberg Economics saying, you know, put PPI and CPI together, you're in deflation territory.
Yeah, which is, I guess, why the bond market can't stop rallying right now, looking at the economic numbers, too. And I think what's key here, and in case our viewers missed it, too, I think this week we had Winnie Wu who joined us, and the reason I say that is when her number one leading indicator for B of A for Chinese equity markets is credit growth. Yes. And we are entering the window where we could get December credit numbers coming through. So what they're basically saying is when that picks up, expect the economy to follow in a couple of months' time. In between that, the market should start to see that coming, and that's where we might actually see the market start to rally shorter term. So it could happen second half of this year, assuming the credit numbers start to reflect sometime over the next few months or so.
And that is the big if, you know, because despite all of these stimulus measures, you just do not see it playing out so far in demand for corporate from households, for loan demand from corporates and households. Really, I'm battling today.
Yeah. Well, thank God we're about to end the show.
10 seconds left. We are done for the China show. We've got insights with Haslinder Amin. That's next. Stay with us.